Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Chase, yeah, I'd like to ask you a question. I guess other people are going to be typing their questions in, but I know that you see so many investors, traders each day, and you help them with their strategies. How do you guide a trader into certain strategies? I mean, there are hundreds and hundreds of option strategies.
Yep.
What's the first thing that you sort of discuss with traders to try to get them on the right path?
Well, the way I look at it, and Steve, I think you subscribe to the same mentality, is we like to keep it as simple as possible. So often when we go online and we Google the options market and you come up with so many advanced strategies that are seemingly attractive to options, to sort of budding option traders, just because of their complexities and how they're designed to take advantage of this condition or that condition. But what we try to do is we really try to start with the basics, and we really try to get our students to focus more so on keeping it simple, but putting more time and effort into understanding the importance of risk management, capital allocation, trading psychology. So in other words, you can implement any strategy you want. You can do a butterfly, a condor, an iron condor. You can be an option seller. That's all well and good, but what is your risk, and how are you going to manage that risk? And we kind of look at it too, like as at least amongst the partners here in the office, is we have our bread and butter strategies, and we have our caviar strategies. And our bread and butter strategies would be our buying a call, buying a put based on a particular directional bias, looking, of course, at whether or not the option contracts are expensive or not, maybe adjusting and creating a debit spread accordingly. But those would be our bread and butter strategies. And for me and for those of us in the office here, we live day to day on bread and butter. And every once in a while, when certain market conditions are reflecting, say a security that's trading sideways, but implied volatility seems to be high and option premiums are attractive, maybe we want to go in and sort of, when everything is lining up, we maybe want to create some sort of a strategy that allows us to be an option seller. But for the most part, keeping it simple and focusing more on risk management is what's going to keep people in business, not so much worrying about what the next best, quadruple leg strategy is that's going to, give them a high percentage probability of being right.
That's a great answer, and I do subscribe to that. Keeping it simple is so important. And the more that we use technology, the more careful we have to be, because I'm sure, Jason, a lot of the students that come in to see you will show you cool calculators, probability calculators, and I've seen it when I teach classes, that I'm going to be right. This is what attendees told me, I'll be right 94% based on this calculator.
Right.
And that's a dangerous thing for someone that's new or even an intermediate trader, because they don't understand that just because you're right 94% of the time doesn't mean you're going to make money in the long run.
Well, that's actually a great point, and we can sort of look at it in the context of creating some of these more advanced strategies where maybe you have a limited profit potential, but your risk exposure is that much greater. My dad always used to say, "Look, son, you'll do it 9 out of 10 times, and you're going to be safe. But that 10th time, that's the one that's going to cost you." And that holds true in this market as well. When you're looking at some of these different strategies, as you might be right 99% of the time, but if your risk on that 10th time exceeds the profitability of your previous 9 trades, it doesn't matter how successful you've been, you're starting back at square one. And that's why, again, we bring it back to just focusing on that risk versus reward idea and recognizing that that is really where how you stay in business is by managing the risk and capitalizing on the reward, and make sure when you do create your strategies or when you do create any approach to the market that you're weighing out that balance. There are some spread strategies, even under conditions of high market volatility, that just aren't worth putting on, simply because the spread is costing you more than what the ultimate profitability between the strikes is offering. And so those are the situations where you want to stand aside. So although we can look at implied volatility, implied volatility and options pricing and determine what strategy might be best to implement, we still have to then go in and decide whether or not it's an appropriate time to even be in that trade.
That's a great point, Jason. That's a really great point.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.